And I'm Mira.
We have an absolutely fascinating split screen to unpack today for our deep dive.
Oh, it is wild out there today.
Right, because on one side, you have the tech sector just popping champagne.
Yeah.
I mean, they are celebrating these massive trillion-dollar milestones as if the economy has literally never been stronger.
Yeah, complete euphoria.
Exactly. But then you look at the other side, complete naval chaos and geopolitical confusion in the Middle East. It's just the ultimate market irony.
It really is.
We're seeing record highs on the NASDAQ, while the world's most critical energy artery is acting as a complete wild card.
It's a profound day of contradictions. Just to set the baseline for today, Tuesday, May 26, 2026, equities actually experienced a notable midday dip.
They did, yeah. It was looking rough for a minute.
Right, but then they stubbornly recovered to close near the highs. And that recovery, completely led by tech. I mean, S&P 500 futures finished right near the top of their range at $7,532.50.
And the NASDAQ hit a record close.
Exactly, a new record. Meanwhile, Treasury yields and credit spreads remain remarkably stable through all of this.
Which is surprising.
Very. And oil was just highly volatile, though it ultimately closed slightly lower on the day.
Well, that sets up our agenda perfectly. So here is exactly what you are getting in today's deep dive. First, we'll look at the overseas macro setup and the latest diplomatic moves.
The peace talks.
Right. Second, we're diving into the deeply contradictory news that just whipped through the US trading session. Third, we'll cover those massive corporate tech milestones, give you our closing bell joke, and tell you what to watch tomorrow.
Lots of data tomorrow.
Always. And finally, stick around for our live paper trading segment.
And just a quick note to you, our listener, before we begin. This deep dive is strictly for market context and discussion. It is not personal investment advice or an investment recommendation.
Okay, let's jump right in. Session one. What set the stage before the U.S. session opened?
So you really have to view this morning's action through the carryover context from this past weekend and yesterday, May 24th and 25th.
Right, the baseline was already tense.
Extremely tense. We had the U.S. and Israel's Operation Roaring Lion, the resulting Iranian closure of the Strait of Hormuz, and then yesterday's defensive U.S. strikes on Iranian missile sites.
And we talk a lot about geopolitical brinkmanship as an unhedgeable tail risk.
We do, and that has been the defining macro cloud hanging over everything.
Which makes today's pre-market catalyst so incredibly jarring. Suddenly, the narrative just shifts to this massive $24 billion truce.
Yeah, out of nowhere.
U.S. Secretary of State Rubio confirmed active negotiations in Qatar. And on paper, the core of this emerging deal sounds very straightforward.
A truce and the reopening of Hormuz.
Right, in exchange for unfreezing up to $24 billion in Iranian funds. But when you look at the details, there's a massive sticking point here.
The upfront demand.
Exactly. Iranian sources are demanding that half of those funds, $12 billion, be available the exact moment the Memorandum of Understanding is announced.
Which introduces a huge logistical and diplomatic hurdle. I mean, a Memorandum of Understanding, an MOU, is essentially just a formalized handshake.
It's totally non-binding.
Right. So demanding $12 billion the second that document is announced, that means releasing enormous capital before any physical security is actually verified in the waterway.
See, this is where I'm struggling to understand the market's optimistic assumption that this is just some neat, finalized peace deal.
How do you mean?
Well, looking at it through a game theoretic lens, if Iran is simply demanding half the money up front for a non-binding piece of paper, are they actually committing to anything?
I see what you're saying.
Right. Or are they just using the threat of a prolonged blockade to extract the cash up front?
Yeah.
Because if they secure that $12 billion, the risk isn't actually resolved. It's just paused.
They could easily re-escalate once the funds clear.
Exactly. The structural leverage would remain entirely intact.
And, looking overseas, global central banks are absolutely not waiting around for a peace deal to save them. They are operating as if this is baked in.
They're still hiking, right?
Yeah. Overnight, Bank of Japan Deputy Governor Himino explicitly signaled they plan to continue raising policy rates despite the whole Middle East situation.
Wow.
Because Japan imports a massive portion of its energy. So a Hormuz closure imports inflation directly onto their shores.
So the BOJ is hiking right into an energy shock.
Yeah.
And Europe is doing the exact same thing.
They are. The ECB's Isabel Schnabel was out pushing for a June rate hike regardless of whether a truce is signed or not.
Because central bank credibility as an inflation anchor is all that matters to them right now.
Exactly. They cannot afford to let a temporary energy shock bleed into long-term inflation expectations.
Okay, so to briefly wrap up session one, overseas markets essentially set a tone of cautious diplomatic optimism, but it was heavily counterbalanced by hawkish central banks.
Very hawkish.
We're going to take a short break right here. When we come back, we'll dive into session two and figure out how the domestic markets handled this tension.
See you in a minute.
And we are back. Moving right into session two, what moved markets during U.S. trading hours?
Honestly, the defining feature of the U.S. session was just absolute whiplash.
Especially in oil.
Particularly around the Hormuz escort situation. We saw extreme volatility in crude. West Texas Intermediate WTI swung wildly between $89.41 and $94.70.
That is a massive intraday spread.
It's huge. It finally settled just slightly lower at $93.55. But that kind of swing for a commodity that dictates global economic health is crazy.
And what's wild is that the volatility wasn't even driven by fundamental supply data.
No,
It was driven by this barrage of completely contradictory headlines. I mean, first, the Wall Street Journal reports the U.S. Navy restarted guiding ships under Project Freedom.
So the market immediately starts pricing instability.
Right. But then, by 12:29 p.m. Eastern Time, U.S. CNTCOM explicitly denies the report. They say they are not currently escorting commercial vessels.
Which creates a total informational void. Who actually controls a waterway that handles a fifth of the world's daily oil?
But it gets worse. While CNTCOM is denying everything, the UK Maritime Trade Operations reports a tanker explosion off the coast of Oman.
At the exact same time.
And then Iran's IRGC claims that 25 ships safely passed through the strait today, specifically with their permission.
So we have three different entities claiming three completely different realities.
It's like, think of it like a chaotic traffic intersection. The traffic lights are completely out. You have three different people standing in the middle trying to direct cars.
Sounds dangerous.
It is. Nobody knows who actually has the authority, yet the market is pricing it as if traffic is flowing perfectly smoothly.
Well, the domestic data really validated that ignorance today. The U.S. economy seemed entirely disconnected from the naval chaos.
What were the numbers looking like?
At 10 a.m. Eastern Time, the Conference Board's Consumer Confidence Index printed at a really solid 93.1.
Oh, wow. That beat forecasts, right?
It did, slightly. And 12-month inflation expectations actually ticked downward. Consumers are resilient.
And the market rewarded that immediately. Look at the Russell 2000. It jumped 1.8% to close at 2,920.54.
Right, and small caps are highly dependent on domestic consumer spending.
So people are feeling confident about a soft landing. But how does that square with the Treasury auctions this afternoon? Because the bond market was telling a completely different story.
The bond market is always the reality check. You have to contrast that consumer optimism with borrowing costs. We had some heavy Treasury auctions this afternoon.
Where the government is asking investors to fund its debt.
Exactly. And the 2-year note cleared at a high yield of 4.071%. The 6-month cleared at 3.65%.
Which brings us back to discount rates as financial gravity.
Always. Investors are demanding higher short-end compensation. They're wary of sticky inflation, and they're bracing for the incoming Fed chair, Kevin Warsh.
Who is expected to take a very hard line.
A very hard line.
Okay, wrapping up session two. The U.S. session was defined by a huge tug-of-war. Resilient small-cap bidding clashing with chaotic, contradictory oil markets and high Treasury yields.
We'll take a quick break, and then we'll get into the corporate side of things.
Welcome back to our final regular segment, session three. What is our corporate events recap, and what should we watch next?
So the undeniable story of the day, the thing keeping everyone distracted, is Micron technology, ticker MU.
Unbelievable day for them.
They surged 19% today, and in doing so, they officially crossed the $1 trillion market capitalization mark.
Which is just staggering. And that move was the primary engine behind the NASDAQ, hitting that new record close of 26,656.28.
Absolutely.
But 19% in a single day for a company that size. We're talking hundreds of billions of dollars in value created in hours. Why is the market pouring this much capital into semiconductors when the global energy supply is so volatile?
Because the market recognizes this isn't just software hype anymore. It is a physical infrastructure build-out. Today, Qualcomm struck a new AI chip deal with ByteDance.
Right.
We also have upcoming infrastructure panels. This is AI CapEx as a cycle-agnostic arms race.
The hyperscalers are just spending endlessly.
Hundreds of billions on data centers and specialized silicon. They are deploying this capital regardless of interest rates, regardless of Hormuz. AI hardware is the new economic bedrock.
I have to challenge this narrative, though.
Go for it.
Is this tech euphoria acting as a shield? Or is it just completely disconnected from reality? I mean, is the AI boom the only thing doing the heavy lifting for the S&P 500 right now?
It's certainly carrying the weight.
Because it feels like it's masking the macro pain. While Micron adds billions, everyday consumers are facing energy shocks as a delayed consumer tax.
Yeah, that tax is very real.
Right. If oil spikes back to $100 a barrel, AI chips aren't going to make gasoline cheaper. It feels like tech market caps are hiding the fragility of the broader economy.
It is masking it. You're basically looking at two different economies trading under one index.
Exactly.
You either hold the companies building the cycle-agnostic future, or you hold the companies held hostage by geopolitics.
Which perfectly sets up our dedicated closing bell joke for today. Here is the read directly from our source material.
Let's hear it.
Micron just joined the $1 trillion club, proving the only thing expanding faster than AI is geopolitical confusion. If you're holding tech, you're popping champagne. If you're trying to figure out the U.S. Navy in Hormuz, you need a stronger drink.
Very true.
With Qatari peace talks, hawkish banks, and tariffs flying around, apparently, as long as we keep buying semiconductors, the market thinks everything is fine. When macro gets tough, just ask an AI to fix your portfolio.
It's funny because it's painfully accurate.
So what are we watching tomorrow?
Okay, Wednesday, May 27th, the calendar is packed. We have Fed Governor Logan delivering a speech right out of the gate at 8 a.m. Eastern Time.
That'll give us a read on how the Fed is digesting inflation.
Right. Then we get a crucial look at the labor market. The ADP employment change drops at 12:20 p.m. ET.
Nice.
And finally, the Richmond Fed Manufacturing Index will be released at 2 p.m. ET.
Now, before we transition to our paper trading segment, there is a collision between these two narratives, the AI boom and the energy shock that we need to touch on.
Yes. I want to leave you, our listener, with a provocative thought to mull over.
Lay it on us.
We are watching AI data centers demand unprecedented amounts of electrical power, right? The grid is strained, but at the same time, global energy choke points like Hormuz are incredibly vulnerable.
Vulnerable.
So will these trillion-dollar tech hyperscalers eventually be forced to fund their own physical energy security?
Oh, wow. Like sovereign infrastructure.
Exactly. Are we going to see tech monopolies building their own nuclear power plants just to protect their AI investments from global energy shocks?
You know, given the scale of capital they deploy, a private tech-funded nuclear reactor doesn't even sound like science fiction anymore.
Just a corporate insurance policy.
All right, let's get into our bonus session, paper trading.
Time to see if our macro theories actually translate to returns.
For those of you new to the deep dive, we started a live paper trading experiment on April 17th. Starting balance was $10,000.
And we have strict rules.
Very strict. Limited to 13 broad macro ETFs, maximum allocation of 10% per trade. Here are the current stats as of today, May 26th.
How are we doing?
Our portfolio value is sitting at $11,089.47. That is a 10.89% return, beating the S&P 500's 5.52% return over the same period.
Nice outperformance.
And our unallocated cash sits at $33.26. So what are your specific trade decisions for tomorrow's close-in?
Well, let's hear yours first.
Fair enough. I'm making two specific moves based on today's diplomatic news. I'm selling $1,100 of XLE, the energy sector ETF.
Okay.
And I'm immediately rotating that capital to buy $1,100 of XLY, the consumer discretionary ETF.
Walk me through the fundamental justification there.
It comes down to the idea that markets price forward. I believe over the next 24 hours, algos are going to aggressively price in this $24 billion Qatar peace deal.
Regardless of whether the physical security is guaranteed.
Exactly. The war-driven risk premium in oil is going to evaporate in the short term. We saw WTI's vulnerability today, dipping to $89.
Right.
So if energy shocks are a delayed consumer tax, the reverse is true. As oil drops, the consumer gets a massive tax cut. Combined with today's strong consumer confidence print of 93.1, XLY is the best vehicle for a soft landing.
I like it. And the macro read on oil losing its risk premium makes sense to me, so I'm also going to sell XLE. But I'll size my sell slightly smaller at $1,000, and I'm taking a completely different path with that freed up capital. I'm allocating my entire $1,000 buy to XLU, the utilities ETF.
Wait, utilities, that's a super defensive play in a market hitting record highs. Why?
It connects right back to that provocative thought about tech companies needing sovereign power. Yes, geopolitical risk is fading for oil, but look at Micron's $1 trillion valuation today. The physical reality is that energy access is the AI bottleneck.
That's structural demand on the grid.
Exactly. Hyperscalers are deploying historic capex into data centers. And when you see nations like Japan subsidizing energy and pivoting to nuclear, it's clear power generation is the vital frontier.
So XLU is the play.
XLU is the critical secondary beneficiary of the entire AI revolution. They own the grid the monopolies desperately need.
You are playing the semiconductor boom by buying the power lines. I love that secondary derivative trade.
Thanks.
Okay, here are the aggregated final decisions to be executed at tomorrow's close, May 27th. We are selling XLE for $1,050, which is 9.5%. We are buying XLU for $500, which is 4.5%. We are buying XLY for $550, representing 5.0%.
And as always, our final brief disclaimer, this is a live paper trading experiment meant for educational discussion. It is not financial advice, so please do not copy these trades.
Let us know in the comments if you think the AI boom can outrun a Middle East bottleneck, and we'll see you tomorrow.